Most people moving provinces to dodge taxes forget to calculate the one cost that erases their first 3 years of savings entirely. Here's the popular narrative. You check the top marginal rate in Alberta versus Ontario or BC. You see a gap that looks like thousands of dollars a year, and you start packing boxes. It sounds like a no-brainer. People post about it online like they cracked the code. But here's what the data actually shows. The moment you move, costs start stacking. Land transfer taxes on your new property. Provincial licensing transfers if you're in a regulated profession. Pension adjustments if your employer plan is province-specific. And if your spouse works, their income gets recalculated under the new province's rules too. These aren't edge cases. They're standard. Now run the real math. Those hidden transaction and adjustment costs routinely consume 60 to 80% of your projected tax savings across the first 3 years. You thought you were ahead. You weren't even close to break-even yet. And break-even is the part nobody talks about. Because of that cost drag, independent financial modeling consistently puts the true break-even point somewhere between 7 and 12 years after the move. 7 to 12 years is a long time. Long enough for a job loss, a rate change, a family situation that flips your entire income picture. If any of that happens before you cross that break-even line, the whole calculation goes negative. And now, you're not just financially behind, you're geographically trapped by the sunk costs of the move itself. So before you relocate for tax reasons, model the full picture, not just the marginal rate gap. Every transaction cost, every licensing fee, every spousal income impact. Then ask yourself honestly, do you have 12 uninterrupted years of stability to make this work? If the answer isn't certain, the math probably isn't either.